Mic's on, so it's a great pleasure to welcome Raghuram Rajan. Raghu is the Katherine Dusak Miller Distinguished Service Professor of Finance at Chicago Booth. Of course, between 2013 and 2016, he was governor of the Reserve Bank of India. And a decade prior to that, he was chief economist at the IMF. So, Raghu, it's an absolute pleasure to welcome you to our conference and sharing your insights with us. The way we're going to run this, I think, is I want to leave plenty of time for all the great questions we'll get from the audience. So we'll do about 30 minutes chats between the two of us, and then we'll have 30 minutes for questions. So kind of store up your difficult questions. I'm sure there are many at this juncture right now. Perhaps we could start, I think it's the inevitable place we need to start, with the rise in inflation, and I'd just be interested in your thoughts on this. So, what do you see happening to inflation rates in the US, UK, Euro area over the next year or so? And I'm particularly interested, looking slightly beyond that, are you more concerned about risks of prolonged continued overheating, or do you think we might find ourselves back in a world of, deflationary concerns being the main concern?
Obviously, it's a great and pressing question. I mean, clearly, some of it depends on things outside the central bank. Mr. Putin, for example, what he does on energy, whether he continues some of the inflationary pressures that we already see, certainly for headline. But I think the BIS had a very good characterization of thinking about where we are. We're coming from a low inflation regime where any price movement doesn't necessarily stick. There are relative price adjustments. You don't see an overall movement in inflation to a high inflation regime where price movements get sort of augmented by the whole, and you see it doesn't stabilize on its own, and central banks have to take a much more active role. It seems a little bit to me like moving from a developed country to an emerging market. You got to do a lot more as a central bank in containing inflation, certainly relative to the last so many years. So in that situation, I think central banks have limited time to prevent the equilibrium sort of from moving to one which is used to higher inflation, and then you get the wage price inflation spiral because every element of inflation has to be corrected for through higher wages. I think central bankers recognize this. That's why so many of them have front-loaded movements. But of course, it's also a difficult time because there are so many aspects which are largely supply side. You want to worry about them because they feed into the overall inflationary environment and may get entrenched into expectations. But you also want to be careful because the economy is not doing that well. And so you don't want to create a really strong recession. So when you mention these three areas, I think they're in different sort of situations. US, I think the Fed has moved, perhaps a little later than we would say in hindsight was appropriate. But it has moved, and it has said that it's very firmly concerned about inflation. When you look at wages, 5% nominal increases, still not keeping pace with inflation. And in the US, we don't have the kind of institutionalized wage structures. AFL-CIO is much less powerful than it used to be. And so one would think that it's going to be harder for the wage price spiral to take off. And perhaps the Fed will keep us still in more closer to that first low inflation equilibrium rather than the second. So to your question, so long as we don't see further supply shocks which give more momentum to inflation, I suspect it has a fairly good chance of succeeding over 2 years, bringing things back to somewhere nearer normal. I think in the euro area, we still see a chunk of the inflation right now being energy. and that's going to come off with base effects. It's now they have a more institutionalized wage setting process. We've already seen the German unions asking for higher wage increases. But if the ECB can do enough, perhaps they can still maintain reasonable sort of balance between growth and inflation. They bring inflation down, and they don't have a deep recession. The UK is the tough part, right? I think what we're seeing is certainly the lagged effects, in part lagged effects of Brexit, both on the labor market side, with a very tight labor market, partly, I would guess, for the same reasons as the US, very limited immigration over the last few years creates pressures, perhaps more in the UK than in the US, because the US, it has been immigration at the lower end, which has largely been cut off. But in the UK, it may be more general across the board. And of course, the growth effects of Brexit, which had to show up at some point and are starting to show up at probably the worst time. So with all that, I think the growth inflation trade-off is harder. I can understand the Bank of England's dilemma. Again, with the benefit of hindsight, perhaps being more forceful up front about raising rates and trying to, limit inflationary expectations. Of course, again, the UK, as we've seen with the rail strikes, has a more institutionalized wage bargaining system than the US, and that may make it harder for the UK to bring inflation under control. Now, longer term for the US, if it does bring inflation under control, I do worry we're back in the pre-pandemic, using Larry Summers' terminology, secular stagnation, because I don't see where the new growth is going to come from that wasn't there at that time, right? I mean, we had $6 trillion of stimulus, but the central bank is going to react to that, and we're going to come back to relatively modest growth. And the $6 trillion hasn't been used to create the structural reforms or to create the investment that would necessarily, maybe $500 billion for investment, but that's small change relative to what's been spent. And so, in terms of sustained growth, I think we still need to worry about whether TFP is going to grow or not. And again, there we've seen some changes in work habits. Maybe that adds to TFP, but by and large, there's headwinds, deglobalization, the fact that immigration, there's probably going to be more resistance to it going forward. The labor force is going to grow older, and TFP maybe on the service side more of it, but again, it's going to be miraculous if it just pops up by a huge amount. So broadly, I don't see that we're going to have rollicking real growth. R-star is going to pop up a lot. And I think the best we can hope for is, moderation again. We will like the times before the pandemic. We'll grow to like the past. I think that's going to be, unfortunately, the future.
Interesting. Maybe we can sense a fiscal policy. So, one of the legacies of the pandemic and even the global financial crisis before that is, all of these events are happening against the backdrop of very high public debt levels. You've written about the impact of QE in shortening the effective maturity of public debt in the hands of the private sector. Are you concerned that, with this world of rising interest rates, this could create debt sustainability issues for some countries? Could we even have a fiscal crisis? How should we think about these issues?
Well, one of the nice things about high unanticipated inflation is it reduces your public debt level, right? So I think that's the silver lining of this. It's going to create some room. Of course, going forward, there's a question of how that new debt is going to be priced, and whether you have an inflation premium embedded in it, and therefore are you going to pay higher real rates, what it does to public debt sustainability going forward, and how quickly that repricing takes place, which is where the maturity of the debt comes in. And clearly, shorter maturity debt has two problems. One, it's harder to inflate away, and second, it has to be repriced much more quickly. And so some of the higher interest rates, including higher real interest compensation that investors demand, will start showing up earlier. But I think the fiscal front, I do worry, about, certainly in the US, what form spending took in the last few rounds of pandemic stimulus. I can understand why the first round was, we don't know what's happening, let's just spend it freely. The second and the third round, I think, has seriously limited fiscal space for the stuff that the US needs to do. And I said it then. I said, I agreed with Larry Summers' view that the spending was going to be inflationary, but I worried as much that the spending was reducing fiscal room for the things the US needed in order to create higher sustainable growth going forward, including investment in people, but also investment in the infrastructure, as well as in climate change. And my worry is, we used the period when all the economists were telling us, interest rates are really low, go out and spend. We spent it, but not necessarily in the best way possible for the future. And I don't know if, how we can bring this back. It seems, let me put it this way, it seems like in the same way as monetary policy has moved to an emerging market kind of situation, fiscal policy behaved like an emerging market. Spend freely because that's the only way you get consensus amongst the very diverging parties within the country. The political parties don't agree except on one thing, spend. And therefore, you need goodies for each side. You want benefits for the business people, we want benefits for the poor people. And so let's agree, we'll spend on both. We won't make choices. And as a result, we spend our way into a fiscal problem. We aren't there yet. The inflation will help us resolve it. But going forward, unless we get consensus, political consensus, unless we start trusting the experts again a little bit, I worry about the future.
And the euro area? Would you like to say anything about that? I'm sure we'll get questions in the Q&A on this.
On the fiscal side or on the fragmentation side?
I think I mean more on the fragmentation side, yeah.
I mean, clearly it's a huge issue. And, my friend Axel Weber was saying forcefully, I don't know whether he wants it repeated, but once again, it's up to the central banks to fix the problem, when in fact it should be on the side of the, the fiscal authorities. I do worry if we don't have, the appropriate reforms in Italy, as well as some kind of a political, a reasonable political outcome post-Draghi. Anticipating all that, whether the markets are going to test the ECB. Of course, we don't know what the anti-fragmentation tool will be, but as we can see the markets testing, Mr. Kuroda in Japan, I have no doubt that this view that central banks can spend limitless amount of money, well, to some extent, but you need there to be a sense that the problem is fixable. If there is a sense that this is going to break down, markets are going to be very quick to test. And so what is the level of support the ECB is going to give? I like the fact they've left it a little up in the air. What does fragmentation truly mean? Well, if it goes beyond what is reasonable, if yields pop up beyond what is reasonable, we will bring it back. Now, I think they'll have to be very clever about defining that reasonable, because anytime they draw a line in the sand, it will be tested.
That's interesting. That's a segue to financial stability questions more broadly. There's a few things I'd be really interested in your views on. So one is, I guess on the risks side, do you see this kind of prospect of, maybe quite steep increases in interest rates possibly leading to financial stability concerns, either in advanced economies or emerging markets? Are there particular pockets of vulnerability that you're concerned about?
Well, let's start with the interventions in COVID, right? You can see this was a big shock, and you can see the bankruptcy numbers. They look really healthy, right? Far fewer firms went bankrupt in the US, and I think that's true also of Europe. So what happened? Either there wasn't a problem, which doesn't seem to be the case, or there are a number of firms which have loaded up on debt, which they probably will not be able to service as times get more difficult. So I would combine it with the fact that, yes, times are going to get more difficult with higher interest rates, with the economies slowing because of supply shocks, but also because of the higher interest rates. In those difficult times, we're going to have to confront higher levels of debt.
Yeah.
And so almost surely there's going to be more distress. The question is that going to be manageable? Is that going to be more problematic? Of course, that depends on how you've lent to those entities. If it's short-term floating rate debt, it's going to be more problematic. Now, clearly a lot of corporations that could borrow longer term did so. They understood this was money that was cheap right now, let's make the best use of it. But there are some firms that couldn't get any other money than short-term, maybe even collateralized debt. So they've exhausted their collateral, they've got short-term debt, they're the ones that are going to face up to it soon. How big that is, it's hard to tell because there's been a fair amount of lending in there. I think the other question is, does this spread? And that depends on the identity of the lender. I think the consensus is that the banks haven't gotten into it in a big way, that much of the froth has come from the non-banks. And there, the real question is, who are these non-banks? We've seen some of them in the crypto area go, belly up. Not all of them have lent to the real sector, but some of them have. But I think the bigger question is some of this private lending that has taken place. Have these been done by leveraged institutions? And how much due diligence have they applied? How well diversified are they? How much capital they have? All the same questions we asked of the banks.
Yeah.
Shadow banking system is the big question now.
Before we go there, I want to ask you about banks, actually. Take you back to there is I think this is still a debate that's, you hear a lot about, have we actually fixed the problem of bank resilience, from the last crisis? And I think there's two views that seem so distinct that it's hard to kind of make progress in the debate from my perspective. So one is, this is not an issue anymore. We do really strict bank stress tests. They've got much more capital than they had pre-global financial crisis. Look elsewhere. The other view, a lot of economists take the view that we should have much higher bank equity requirements. Where do you stand on that kind of quite fundamental debate?
I guess it goes back to the question of what you think a bank is, right? What is a bank? And I would say the defining characteristic of a bank comes from the liability side, essentially short-term demandable claims. And, if you have short-term demandable claims, the argument always is, why don't you invest in short-term liquid assets, and then there are no problems for the system. But then you're not really creating liquidity, and liquidity creation means some level of liquidity risk, longer-term investments. Then the question is, why do you finance with short-term demandable claims? And this is where people like Martin Hellwig, Anant Admati said, why not just increase the capital ratio? Now, some of us, Doug Diamond and I, for example, say, look, the problem is financing long-term basically creates a very high cost of capital base for the banks. don't keep reciting Modigliani Miller again and again. It doesn't apply in this case. There are different problems that violate the assumptions of Modigliani Miller in this situation. And so short-term demandable claims may be a better way of financing for the banks. And that allows them to do the maturity transformation, but also exposes them to risk. So yes, there's a trade-off. You cannot have infinite capital, but you cannot have zero capital. There's an optimal level of capital requirement, and we're struggling to find what that is. If you set it too high, it makes them unprofitable. You set it too low, it makes them overly risky. How do we find the balance? And Basel 2, 3, 4 are all struggling to find that balance. Are we there yet? We'll find out over time. I do think that drawing banks away from some of the valuable activities they provide will be problematic. We shouldn't over-regulate what they do on the asset side. By all means, regulate capital, make sure they have sufficient capital, but allow them also to perform contingent risk bearing, which is a very important function. In a sense, the ability to intervene at the right times. If you take that out, now some of the arguments are they've been doing that right during in recent times. I think that should be encouraged. That banks have to be part of the answer, and we can't just pull them back from risk taking.
Liquidity provision.
Liquidity provision of various kinds. You just have to make sure they understand that they are providing that liquidity, they're on the hook for it, and they don't over-provide it and run down the price of providing that and basically create problems for themselves, which also happens.
Coming back to non-banks then, so I guess what's quite striking is we keep having the same vulnerabilities showing up again and again in the non-bank space, it seems to me. Money market funds in the US, issues around liquidity transformation in investment funds were highlighted 8-9 years ago, yet very little is actually done on the policy front on this. I'd just be interested in your views on, where's the starting point and how optimistic are you we can actually address some of these vulnerabilities that keep showing up?
Well, any kind of liquidity transformation can be profitable, but also involves a fair amount of risk, right? Risk return, you're getting paid for it. And ideally what you'd like to do is, take the risk, get paid for it, and hope that the authorities come out to bail you out at the right time. I mean, that's certainly what the money market funds are doing. Yeah. They have a direct line. In times of trouble, the authorities come to help them, and they've gotten used to that. But the other side of it is the political economy. John, in the previous panel, was talking about the political economy of regulation. Part of the problem is when the entity you're regulating is part of a big group, the amount of lobbying power that group can exercise, right? This is particularly problematic with innovation. When the innovation is small, that's the best time to regulate, but you don't know anything about what to regulate and how to regulate, right? I have in mind, of course, the crypto markets. We didn't know early on what to regulate and how to regulate. By the time you find out, it's really big, and they have a ton of lobbyists they can buy to prevent regulation from happening. So there is a real question of how do you achieve optimal regulation in this kind of environment. By the time you know what to do, it's too late. So do you regulate extensively upfront, but then you never find out what to do because it doesn't grow? So how do you match this? I think from a regulatory perspective. So, I thought after we woke up to the fact that people were doing all sorts of stuff with subprime, and it wasn't what we knew they were doing, we'd move faster to regulate cryptos. But of course, what do we do?
Yeah.
And now it's a 3 trillion down to 1 trillion. And now we're saying, well, we should regulate. Maybe the experience of 3 down to 1 is enough to overcome some of the lobby groups which said, don't even touch us. We're so profitable that you're the old school. You don't understand. We're not taking any risk.
Interesting. All right, I want to finish with two quite general questions. So one is interested in your views on the enduring lessons for public economic policy from the pandemic. I guess I'm thinking particularly whether there are lessons on the fiscal side, but you can take that wherever you'd like to take it.
Well, I'm not sure I know what the lessons are. I do worry that a lot of the money we spent went in ways that in hindsight we will regret. And we will see more and more studies. We've already seen some studies saying money that went in through the front door in the Paycheck Protection Program went out through the back door to pay the banks. That's why bank loan losses are much lower than we thought they would be. Was that a good use of money? Did you want to recapitalize the banks by funding the small and medium enterprises? I don't know. And I think that one aspect that has been highlighted is we need to prepare for more emergencies and how to funnel money directly into households and also know who we are funneling to. Much better targeting, because we simply cannot afford the blanket everybody gets. I mean, why did people on Social Security, and I'm in that, nearing that age where I'm going to receive Social Security, they didn't lose a job. Why did they have to get the same fiscal transfer as the head of a family of 4 who just lost a job? It seems like we can do better targeting. Well, initially we couldn't because we didn't know, but we didn't spend any time, trying to figure out more. At least now we should try and figure out who's who and what's what. And of course, there is going to be privacy concerns. Should the government know who's getting what income? But if you want to make transfers, and we have the capacity to make transfers in a much more targeted way, can we figure out, so that next time, and emergencies are going to increase in number, obviously, if we don't tackle climate change. And they are going to be the kind of emergencies where you want direct transfers to people, or you've just had a catastrophe and you have a house in Miami. Let's make some transfers.
Takes us back to CBDC, perhaps. Last question from me is, we've got a number of young researchers in the audience. So what would your advice be to people on the research side? Where would you like to see people focusing, especially these days?
I would say the immediate answer is don't listen to anything I say. Whenever you hear older people talking about research they wish they wish you would do, either it is stuff they don't think worth working on themselves, or it is stuff related to their research that they hope that you will expand and make their research much more interesting, right? So take everything I say with enormous amounts of salt. I think there's so many interesting things that have come up in the last few years that are certainly worth working on. And we just talked about one big issue. What is the fiscal monetary interaction, right? We just saw $6 trillion being spent by the US Congress in generating a recovery. And we're going to see some of that recovery being killed by the central bank raising interest rates, maybe in proportion to the amount that was spent. Is this the best form of monetary fiscal coordination we can think of, or are there better? Now, obviously oversimplifying, there are lots of shocks which have happened, which neither the monetary authority nor the fiscal authority, nobody anticipated the war. So yes, but are there better ways of coordination? What should they be? How do we think about that? That's certainly, one of the important issues. I see an increasing number of papers on digital currencies, on cryptos. All the issues we heard talk about in the previous panel, I think going to be very interesting. One of the immediate areas, if I was to throw out something, is certainly, when we look at some of these new digital organizations or institutions, how successful have they been? Have they really captured information in a much better way? For example, in lending, we will go through a cycle. We didn't go through much of a cycle during the pandemic because of the enormous amounts of money, but maybe we go through more of a cycle in combating inflation. How many of them survive? What did they do that was different? Or is it that they just made loans in good times, and it looked like it was a whole new technology, but it didn't survive the bad times? I don't know the answer to that. I do worry that we have perhaps overestimated the value of new information that they've brought to bear, but I certainly may be wrong, and maybe there are a lot of these companies that come through the downturn, smelling like roses. They've really figured out the individual and what makes them tick, and so there's tremendous amounts of work that can be done. Last point. I think the issue of liquidity, that's my favorite. And so I'm telling you that I have a vested interest, but I think we understand too little what liquidity really is and what happens when it vanishes. We certainly have a belief when central banks reduce their balance sheets, you're trading one high-quality asset, long-term government bonds, for another high-quality asset, central bank reserves. Other than some maturity transformation, it shouldn't make much of a difference. I suspect it could make more of a difference, and we have to see what happens as central banks shrink their balance sheet.
Yeah, live experiments on that question.
Absolutely.
All right, I'm sure we're going to have lots of questions. So why don't we take like 2 or 3, and then we can have another round. So who wants to go first? All right, I see Gulchin. I also see Dabika. Don't know your name, but you can go third.
Thank you. Gülçin Özkan, King's Business School. I would like to ask about emerging markets you alluded to earlier. If we go back to the aftermath of global financial crisis, which was obviously a high point for emerging economies with the flooring of interest rates in advanced economies, capital flowing back. And more importantly, these economies had already learned the lessons from their own crisis experience, put their house in order, including the macroprudential policy. We are in a very different point now, particularly with the direction of interest rates in advanced economies. What do you think the prospects for emerging markets are going forward?
It's a great question. I think obviously it differs, right? Emerging markets is a label we use, but you have Turkey on one side, and you have South Korea on the other with the same label, and they're in different situations. I think the question, in some sense, is have they learned how to put their own house in order, more or less? And many of them have moved towards monetary regimes which are more traditional inflation targeting regimes. Many of them have moved in advance of the industrial countries, anticipating, especially in Latin America, take the Brazilian central bank or the Mexican central bank. And so I think they have some difference from the past. But you can see that, certainly India's experience has been portfolio outflows over the last 8 to 10 months. 30 billion, 35 billion have already flown out. Could more flow out? Possibly. And so they have to adjust for that. Many of them have built up reserves during calm times, precisely for this eventuality. The question is, are they willing to let the exchange rate depreciate appropriately and use reserves in modest amounts, or are they going to get stuck in sort of corners in this? On the credit side, I think many of them have banking systems that have been reasonably well supervised. They don't have this overhang of bad loans waiting to be hit by the shocks emanating from the industrial countries. So I would hope that, and many of them don't have the high debt levels that the industrial countries have. So in relative terms, they look better than the past. But I think you correctly point out, this is a different order of magnitude than the global financial crisis. There they were reducing interest rates. They were pushing the flow of capital to the emerging markets. Now we see interest rates going up, the flow of capital going to go the other way. We will see if these systems can stand the stress. Almost surely, not all of them will be able to stand the stress. We've already seen Sri Lanka. I don't know what's going to happen in Turkey, but those are the kinds of questions.
Let's go to Davika next. I saw her hand second.
Hi, my name is Devika. I'm the climate risk analyst at Tata Consultancy Services. You've mentioned climate change at least 2 or 3 times in the last half an hour. So you obviously also strongly affirm to the fact that it's very important. My question is, what are your thoughts on climate risk and its impact to the economy? And secondly, how can central banks help incorporate climate risk into their decision-making agenda?
Okay. This is where I'm going to be controversial a little, hopefully not too much. I certainly think climate risk is very important. But I think putting the burden of fixing it on either corporations or central banks is going to get us suboptimal answers, because those aren't the right entities to fix it. You can give instructions to central banks, but it has to be something determined at the political level. Central banks are unelected. They're not the entities to make choices on this. You can see that even in the US, because there's so much fracture between the Republicans and the Democrats on how important climate change is, for the central bank or officials who are appointed to central bank to talk about which direction they're going to go invites trouble. And I would say limit central banks to the activities they can barely do, which is control inflation and financial stability. And much of the rest has to be, on instructions from the political authorities. Thou shalt not invest in bonds other than these. These are the green bonds you can invest in. That is something the authorities should tell the central banks rather than them, the political authorities, rather than the central bank deciding. Similarly for companies, to leave the entire issue of how much you want to emit to companies, it seems that the political authority is ceding responsibility. Now, the reality is the political authority cannot come together. And so we're sort of saying somebody has to do something. But I think again and again, we see when somebody who's not really the right entity to decide does something, it creates more problems down the line. So I would put the responsibility back to the authorities. Why don't you tell us what emissions we should be doing, and we'll try and stay within that, or you do even better. But for you to say it's the corporations that have to do it and let them figure out, it creates all sorts of problems. For example, if the corporations decide, which corporation is going to decide? Can they form a cartel which decides that, oh, we're going to squeeze all the small guys out by fixing this level of emission, which is impossible for them to reach? Can we squeeze the poor country producers out by saying we will not allow their products in unless they meet this standard? There are lots of inequities, lots of problems that emerge when you leave it to them. I would rather, we focus much more on the global agreement as well as on within country. Here are the things we need to do with the urgency that this needs. And that's the last point I'll say. Having these peripheral entities do it gives you a sense that there's movement, that we are going there. But we're not. We're giving the cosmetics of going there. We really need much stronger action. I mean, we saw the IPCC say we don't have much time before we're inevitably beyond 1.5 degrees additional centigrade. So given that, I do think we need a global agreement sooner rather than later, and that has to be decentralized down to the governments and further down to every entity in the country. But it cannot, I don't think voluntary works in this situation.
I think I saw Jahangir next. So Swarali is just below you.
Thanks. Bit of a horrible question, but I think you asked for it, in that you talked about the challenges that the UK face. Would love to hear, because I hear there's a job opening potentially coming up in the UK. What would you do, the 3 economic policies that you'd have to get UK back on track?
So I'm going to start by saying I'm not competent to answer that question. I don't know. I don't know enough to really answer. If I were to do a study of the possible issues that confront the UK, I mean, look, I can mention what I read, and certainly the issue of, why UK productivity is low seems part of the question that we need to ask and need to fix, and maybe there are easier fixes rather than harder fixes. I presume there's no going back on Brexit. That's a done deal, and it's not going to be reversed. But I would find, all the promises about keeping the UK as part of the global economy and ensuring trade is actually enhanced rather than diminished. I would look at trade and services, and since the UK is strong in that, I would look for ways of expanding global trade and services, but be prepared to do a bunch of, I give you this and you give me that. It seems as if, thinking anew, what are the unexplored areas where we can get growth if, in fact, we are in this new equilibrium is very important. I'm not saying anything new here. I'm just trying to say these are the places I would explore. And certainly, I may not want blanket, that was Brexit. I don't want blanket immigration from Europe. But I would find ways of keeping the tap open for immigrant pools to come in, both to ensure that the labor market is well supplied, but also to benefit from talent from outside. So, those are some of the things that I would do. Some of them are being done. Some of them, I think, could be done. I certainly think globally we need a dialogue on services, especially now that services are so much more tradable than they used to be. We've learned how to trade services during the pandemic. I think that is one of the silver linings. And let's try and expand. 70% of GDP in industrial countries is services. If we can do them more effectively, more efficiently, including by wholesale trade. And trade in services, as you know, is disrupted by things like licensing requirements and this and that. Can we find ways to, in a sense, make that trade more free by figuring out how to diminish the barriers created by this? I think these are things where the UK certainly has an interest in playing a global role.
Marcus Miller.
I have a question about inflation and real wage resistance. In the oil shock of 73-74, Dennis Sargon of LSE came up with an error correction model where the bargaining equilibrium essentially went for a certain real wage. And in reaction to some external shock, which reduced that, the model predicted there'd be a rise in the natural rate of unemployment or a fall in the natural level of employment until this was accommodated by the bargaining equilibrium. So my question would be, do you accept that kind of analysis? And if so, what sort of policies are going to bring people to adjust in the way that may be necessary? And would, for example, the fact that services are much less unionized than manufacturing offer some hope in that direction? Or is it up to the central bank to teach the economy some tough lessons?
I mean, it's a great question. Do I accept the broad principles? Yes. It seems as if that's a reasonable economic model. There are issues of fairness. There are issues of feasibility. I think fairness. Nobody would question that. Trying to reduce real wages is certainly something that is going to impinge on certain parts of the population, perhaps more so in certain parts than others. And there's a redistribution question which arises if you think of a country as an insurance system which is meant to deal with some of this. So let's put that aside, and whether you can get redistribution which is not efficiency impeding, but which makes up for some of these differentials. I think the feasibility issue is as important. That is, and this is Michael earlier. This is his comment, which I thought was very insightful. That reducing real wages after a time of real wage increases, which is what he argues happened in the 70s, is easier than reducing real wages at a time of fairly stagnant real wages for a long time. And so in the current environment, how do you effect that real wage reduction when there's very little credibility about the redistribution mechanisms which make it up to you in other ways? And it comes on top of having a decade of fairly limited real wage growth, maybe decades of real wage growth. And that creates a real political economy problem, right? Because people are now don't think the system sort of works, and there's no surplus built in the past that you can afford to give up. You're at your corner, and you're eating into, you've been making adjustments for the last decade, and you're barely surviving. And now you're being asked to eat into even that. It is a recipe for industrial strife. And so I would say it's really important to work on the other aspect. How can we absorb the shock as a country and make the other adjustments that ensure that the people we're asking to bear the brunt of the shock are willing to do it?
A few more. I can see Jemana to start with, and then...
Thanks a lot for your comments. So my question was more about inflating away debt. I wondered if you could say a bit more on the advantages and disadvantages. And the reason I'm asking the question, the motivation really is, 30 to 40 years ago, it was actually quite a fashionable thing to do, inflate away public debt, inflate away private debt, in particular mortgage debt, something my parents used to talk about. But then it became really unfashionable. In the inflation targeting era, it was like you never asked that question because it was like, no, we're going to have low and stable inflation. So I wondered if you could say a little bit more about where we are now.
Yeah. It works, right? If people don't expect you to do it. So you have to continuously surprise the investor and say, look, you expected 5% inflation, here's 7. And therefore you've got a free ride because they didn't demand appropriate interest rates. Of course, the problem with this is you can keep doing it, eventually they wise up, and then the question is, do they build in additional for the potential surprises, and then it can get into a very bad situation where your interest rates, nominal interest rates, and your real interest rates are both higher than they would otherwise be. This question for the students here. We sort of think that the public sort of anticipates all this, and interest rates embed, likely inflation. But certainly, at least in India, I found that it was very hard for me to convince people that they were better off when inflation came down and interest rates came down, so they were earning a higher real interest rate. They preferred earning a negative real interest rate at higher levels of deposit interest than earning a positive real interest rate at low. I don't know if this is a more general thing, but I got a huge amount of flack when we brought down inflation in India from people who said, I was earning 9% earlier, now I'm earning 6%. This is terrible. And I had to sort of try and do the math to tell them, look, you actually can buy more. But put that aside. I mean, I think these surprises can work. If you've got a lot of long-term debt, which has been negotiated at a very low interest rate, anticipating low inflation. And I think that's what we're doing right now. Now, that said, I mean, to David's earlier comment, it's not as long-term debt as we thought it would be. Certainly, QE has shortened the maturity of debt because the central banks have bought government debt, financing it with overnight debt. That shortens the maturity of the collective balance sheet, and they're paying for it right now. But I think the broader point is, yes, and some people would advise us. This is like the Jubilee, right? We used to, I think it was what, every 50 years you had a Jubilee where all the debts were written off. This was in Babylon. The inflation, the big inflation is like a kind of Jubilee. Debts are written down and we start again. But you know, you can do it only so often before it gets anticipated, and when it gets anticipated, it is costly because there's also real interest rate premium which comes in. Well, so that's a good point, because the question is, in all these situations, you're just shifting the losses, right? You're shifting the losses. Who are you shifting it to is the important question. If you are shifting it to those damn foreign investors, as a country, you're better off, right? Until they wise up. In many countries, you're shifting it to the pension funds and the insurance companies, which is building up a hole that somebody has to fill at some point, which turns out often to be the same taxpayer who's getting a benefit from the lower government debt that has to be serviced. So if you're doing the shuffling around, but at the same time increasing the cost of borrowing, it's not the greatest idea, which goes back to maybe inflation targeting is a good idea rather than a bad idea. Even though it gives a windfall to the current bondholders, longer term, moving to that new equilibrium may be a good thing.
Right, I think we've got time for one more, and I did see a hand. It was your hand, wasn't it? Fred, I don't know your name, so maybe you could introduce yourself.
Thank you so much. Myself, Ashish. And I want to ask Raghu sir one question that I think most of us, and even you, would agree that cryptocurrency in a longer term may not help the economy as such. But what is your thought on central bank itself issuing its own digital currency? And second, sir, a very India-specific question that right now in recent time we find that the RBI has been increasing its doing rate hikes. So what do you think? Is it the right time, or it's delayed, or we have done it much earlier? Because still we don't find economy is reviving in a better still in a better shape.
Yeah. Look, I don't comment on RBI policy just because people think I know more than I do, and I don't know that much. So let me not comment. I don't want to also make life for my successors more difficult. The first question was on cryptos and CBDCs. We had a whole panel on it, of course, and I'd say that the usual thing that the technology underlying cryptocurrencies is interesting, can be used. Maybe the underlying fear of public sector malfeasance, which drives some of the narratives. Oh, the central banks are going to inflate away all currencies, and therefore we need a crypto. I think that's certainly overblown. But I do think the technologies, do we need as much decentralized ledger, or can we do more centralized ledgers? Would that reduce the costs? What is the trusted counterparty? Where do we really need decentralization? Probably cross borders of one place where we want to do it without intermediaries. Those are kinds of things that are raised. I certainly think the technologies are important. I certainly think we still haven't seen killer apps emerge, but we understand the possibility of these killer apps when we heard from the previous panel, the areas where we might find some of them. I think we should allow some of this to flourish under moderately more controlled circumstances. And that means some regulation. I think the regulation is on its way. The last thing I would say is, one of the problems with the crypto market is the problem with any new technology. It sort of promises so much, and we still don't know which promise is going to work out. But in that promise, this could be the thing. You have a lot of people drawn into it, especially young people, especially people who are not particularly rich. And that's the challenge for the authorities also. I mean, in the US, for example, I think 25% of black households have invested in cryptos, more so than white households. And, typically poorer households. And they've been drawn by the allure of easy money, but they're also going to be hugely affected by the losses there. So how do we ensure innovation, sort of the risks are borne by the right people and aren't more generally spread in the population, especially amongst people who are not that able to bear those losses? Those are some of the questions this raises.
Let's draw it to a close there. Thank you so much, Raghu. That was fantastic.
Thank you.
Thank you.